Hey guys, I wanted to take this opportunity to remind you all to like and subscribe. It really helps me to keep getting the best guests onto the podcast. So I really appreciate it if you did. And now onto the video.
Quite advantageous. So for example, and this is the real opportunity right now. I mean, for all your viewers that are out there trying to buy stock, whether they're doing it professionally or whether they're doing it on, Robinhood, I think this is the approach that they should be taking. So what I do is I combine cash secured puts as a tool to buying the equity. So first and foremost, you identify the stock that you want to hold. And again, we can talk about some of those. But once you've identified that there's a truly undervalued opportunity out there, I end up going and looking into the put markets. I look in the option markets and ultimately end up writing a contract that allows someone else to put their stock to me if the shares decline, for example. So a really obvious example would be Berkshire Hathaway itself. So in March, I have on my website and a few other places I show this like $1.7 trillion valuation for Berkshire in 2030. And, I guess it's trading maybe at 400 million or so today. And it dropped a little bit below that. And that's just so wrong. I mean, the price is just so incorrect. And you can break that out pretty quickly and just look at the equity portfolio, the cash on their balance sheet, and then take one of their large companies like Burlington Northern, and you basically have the whole value of the market price. And they've got 90 other subsidiaries that you just kind of get for free. I mean, it's really mispriced, and there's all sorts of reasons that people might not be treating it very fairly at the moment, and that will change. But when market prices fell, the B shares, I believe, went to about 165. And we were able to sell a put contract, write a put contract that went out until September. And we sold it for $18. Our commitment was to buy Berkshire Hathaway stock for $165, and we were paid $18 for that commitment. That means we hold $147 in cash, and then with the $18 that was provided to us, and we have our 165 to buy the stock. So if the shares go below 165, which is just an incredible price, I don't think we'll see prices like that on Berkshire moving forward. And right now it's at about 170. I mean, it's just incredible. So instead of just buying it in the stock market, we were able to write this contract. That contract provides us $18, whether we buy the shares or not. We keep that $18. And until the shares expire, we have an offsetting liability, which is the price of this put contract. And that bounces around in a very volatile way. And in September, when that expires, most likely that contract will expire with a price of zero. Our liability will shrink asymptotically towards zero. And we will keep the $18. And that's a 24.5% yield, annualized yield on Berkshire Hathaway that somebody has paid us to buy their shares if the stock goes down. And it's based on these factors like the VIX, like volatility. And because volatility is so high, the premiums on these types of contracts are extraordinary. People are willing to pay you a huge percent of the underlying stock just to protect themselves. But if you know something on a quantitative level or qualitative level about these businesses, you find you have a very advantageous situation because the trading is done qualitatively, and you're looking at it from a qualitative perspective. So that is the real opportunity. But I will share with you. Do you want me to talk about another company? Because I can share with you a different opportunity.
The Daily Journal.
We can talk about Daily Journal too. Look, Daily Journal doesn't have these contracts, so that's what makes it kind of interesting. But if I will explain very briefly something I think is interesting. There are a number of key shareholders, a great business model in this company, Seritage. And we had a little investment in Seritage a couple of years ago. It ended up taking far too long. I recognize that the price might not move for a long time. So we actually got out, and we had just better uses of our capital. But but it was outstanding. I mean, the business is fine. They have basically 208 properties across America. All of the Sears real estate that was spun out by Eddie Lampert. Buffett owns a piece. A lot of great people are involved in the business, and they have one debt facility. It's all provided by Berkshire Hathaway, and people are misunderstanding the company because Berkshire, in my view, doesn't want to be seen as a vulture, and so they're not going to have some liquidity crisis and then, in effect, steal all the property from the equity holders. That's not their approach to business in general. In fact, I've watched the covenants get lighter over the last few months as they've made some adjustments to help Seritage survive. Now, the price of the stock has fallen from 45 to about 10, and it was as low as 6. Okay, this is extraordinarily volatile business, and there is a small chance, I think, but very small chance, that they really could have a liquidity crisis and a major issue and maybe see the shares go even lower. But I think there's a much bigger chance that we have an outstanding recovery from here. Seritage is 208 properties. Some of them are very, very high quality, and they're building up. These are one-story sort of malls, so the square footage is going to grow quite significantly. But what I would like to share with you is that instead of buying the stock for, let's say, I don't know what it is today, but let's say it's $12 per share. Instead of buying it for $12 a share in the open market, you can write one of these contracts, and you can get about $4 to buy these shares from someone else over the next, say, 7 months through next January. So if I can get $4 to buy it for $12 through January, if I don't buy it, I'm going to earn 50% on my $8 in collateral, 50% return, and I don't even own the stock. Plus, I have a 30% margin of safety where the shares can decline. And so this is just you don't get, sort of 50% IRRs on these products unless the world is in a very uncertain time and volatility is extraordinarily high. So this is just an outstanding opportunity, to use these types of products as a tool to get into whatever company it is that you like. And it's just something we don't see very often.